Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
AutoNation is the largest automotive retailer in the United States, a Fort Lauderdale-based company operating more than 250 franchise dealerships, selling over 75 vehicle brands nationwide.
The company traces its origins to 1991 when Wayne Huizenga built Republic Industries into an auto retail empire through rapid acquisitions. The AutoNation brand was established in 1999 and has since grown to dominate U.S. auto retail at scale.
The business model spans three revenue pillars: new vehicle sales, used vehicle sales, and critically, after-sales services, including parts, maintenance, collision repair, and the highly profitable finance and insurance operations.
Finance and insurance, F&I, is the real profitability engine. AutoNation earns over $3,000 in gross profit per vehicle from F&I alone, a high-margin product bundle that pure digital competitors struggle to replicate with similar penetration.
The after-sales business is structurally recurring. Every vehicle sold creates a future service relationship, and AutoNation's parts, maintenance, and collision centers generate consistent, less cyclical revenue than vehicle sales.
Brand diversification across 75 manufacturers is a genuine moat element. No single automaker represents a majority of AutoNation's revenue, so disruptions to any one brand's lineup or manufacturing have limited impact on the whole.
The premium luxury segment is the largest single revenue category, representing roughly a third of total sales. Luxury brands carry higher transaction prices, richer F&I attachment, and stronger service revenue per vehicle over time.
AutoNation does not pay a regular dividend. The company returns capital primarily through share buybacks, a model that has reduced the share count significantly over time, amplifying per-share earnings growth.
CEO Mike Manley joined in 2022 with deep automotive industry credentials. He ran Fiat Chrysler and before that led the Jeep brand's global turnaround. He brings operational depth and manufacturer relationship expertise to the role.
The competitive landscape includes Lithia Motors, Penske Automotive, and Asbury Automotive, all pursuing scale through acquisitions. AutoNation's differentiation is its brand recognition, digital retailing investments, and after-sales network density.
Digital retailing is a growing strategic priority. AutoNation has invested in online vehicle shopping tools and the AutoNation USA used car store format, an attempt to meet consumers increasingly comfortable with less negotiation and more transparency.
The used vehicle market is an additional growth vector. AutoNation USA standalone used car stores give the company exposure to the broader pre-owned market beyond just trade-ins and certified pre-owned within its franchise stores.
Key threads: new vehicle gross profit per unit normalization as inventory levels recover, after-sales revenue growth pace, F&I performance and regulatory environment, and capital allocation between buybacks and store expansion.
AutoNation is a volume and service story. It wins by putting scale to work through F&I penetration, after-sales density, and brand diversification across the full spectrum of American car buying.
That's the company chapter for AutoNation. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
AutoNation delivered a double-digit EPS beat despite a challenging macro environment for automotive retail. Q1 2026, EPS of $4.69 versus estimates of $4.25, a 10.4% beat. Revenue was $6.6 billion, down 3.2% year over year. Used GPU stabilization and AutoNation finance expansion are the bright spots. This is Charged Alpha. Let's break it down.
AutoNation is the largest automotive retail group in the United States, market cap of $5.6 billion. The company operates approximately 300 new vehicle franchises across 30-plus states, representing brands from Ford and GM to Toyota, BMW, and Mercedes-Benz. The revenue mix spans new vehicle sales, used vehicles, finance and insurance, and a growing service and parts segment.
The automotive retail business model is evolving rapidly from vehicle unit sales, a low-margin, high-volume business, toward finance, insurance, and service revenue, high-margin, recurring income streams. AutoNation Finance, the company's captive lending arm, is the key strategic differentiator. It retains finance receivables on the balance sheet and earns interest income directly rather than passing it through to third-party lenders.
Let's walk the income statement. Revenue of $6.6 billion declined 3.2% year over year. The decline reflects both unit volume pressure, new vehicle sales down as elevated interest rates constrain affordability, and used vehicle GPU normalization from the pandemic-era highs. The EPS became, despite the revenue decline, driven by cost discipline and the higher margin service and finance mix.
On gross profit per unit, used vehicle GPU stabilized at $1,800 per vehicle. The GPU has been declining from the 2022 peak of approximately $5,000 per unit as inventory normalizes and consumers regain pricing leverage. The stabilization at $1,800 is the key signal bulls were watching. It suggests the compression may be reaching a floor.
Finance and insurance revenue per retail unit was flat to slightly higher year over year, the stickiest revenue line in automotive retail. AutoNation Finance, the captive lending arm, is growing its portfolio as the company captures more finance penetration in its own dealerships. The interest rate environment that hurts affordability at the customer level actually benefits AutoNation Finance's yield on its portfolio.
Service and parts revenue grew high single digits year over year, the most valuable growth in the business. Customer-paid service, vehicle service contracts, and collision repair are recurring revenue streams with margins in the 50 to 60% range. As the vehicle fleet ages, average vehicle age now over 12 years, repair demand increases independent of new car sales cycles.
Cash flow and balance sheet. Operating cash flow of $200 million for Q1 is seasonally light. Full-year OCF typically runs $1,500 to $2,000 million. Cash of $300 million against total debt of $2.8 billion reflects the floor plan financing structure typical of automotive retail, where vehicles are purchased on credit from manufacturers. Net debt is $2.5 billion, standard for the business model.
Wall Street consensus is balanced. 6 buy ratings, 6 holds, 1 sell. Average price target of 202 implies approximately 12% upside from current levels. The buy-to-hold split reflects macro uncertainty. Analysts who believe rate cuts are coming favor the buy. Those who see rates staying higher longer hold.
Valuation. AutoNation trades at approximately 23 times trailing earnings and 14 times forward 2026 estimates. Price to book is low single digits. EV to EBITDA is around 7 times. For a capital-light auto retailer with the largest franchise network in the U.S., 14 times forward earnings is inexpensive on an absolute basis. The discount reflects macro sensitivity.
RBC maintained sector perform, citing affordability constraints and the absence of rate cuts as near-term headwinds. Goldman Sachs maintained buy, arguing that the used GPU stabilization and service revenue growth prove AutoNation's earnings model is more resilient than the market credits. The buy camp sees current prices as pricing in too much earnings deterioration.
The cautious camp focuses on the rate environment. The average monthly payment for a new vehicle has hit all-time highs. At current rates and prices, the median U.S. consumer is stretching to afford the average new car payment. Unit demand pressure will persist until rates decline, or manufacturers offer more aggressive incentives, both of which compress margins.
Beta is 1.27, moderately sensitive to macro. Forward EPS of 19.2 for full year 2026 means the stock trades at approximately 13 times next year estimates. That's an attractive multiple for a business with durable service revenue growth, a captive finance arm, and a franchise network that would cost billions to replicate.
The bull case rests on 3 pillars. First, AutoNation Finance compound growth. As the captive finance portfolio grows, interest income diversifies earnings away from unit sales cyclicality. Every dollar of finance receivable on the AutoNation Finance balance sheet generates recurring interest income with predictable default rates tied to AutoNation's own underwriting standards.
Second, used GPU stabilization. The long compression from $5,000 to $1,800 per unit appears to be nearing a floor. If $1,800 holds or expands, the headwind that has weighed on earnings estimates for 12 consecutive quarters becomes neutral or a modest tailwind. Even a $200 per unit improvement on 250,000 used units sold annually is $50 million of incremental gross profit.
Third, service and parts growth as a counter-cyclical flywheel. When new car sales soften, consumers keep older cars longer and spend more on repairs. AutoNation's 300 dealer service and parts infrastructure is the beneficiary of the exact macro environment that pressures new vehicle sales. The service business grows when the retail environment is hardest.
The bear case starts with the affordability crisis. Monthly payments on new vehicles have reached $1,300 to $1,500 for mainstream models. Consumer credit quality is showing early stress signals in automotive delinquencies. If defaults on AutoNation finance receivables increase, the portfolio marks down and earnings estimates fall sharply.
Second, revenue declining 3% year over year is the directional concern. Even with the EPS beat, a top-line decline signals unit volume pressure that cost discipline cannot offset indefinitely. If revenue decline accelerates to 5 to 7% in subsequent quarters, EPS estimates are at risk.
Third, inventory normalization is not complete. New vehicle inventory returned to near normal levels from the supply-constrained pandemic era. As inventory returns, the dealer's pricing power diminishes further. Consumers who previously paid MSRP or above now have the leverage to negotiate below sticker, compressing new vehicle gross margins.
AutoNation's peer group includes Lithia Motors, LA market cap $11 billion, Penske Automotive, HAG, $9 billion, CarMax, KMX, $14 billion, and Asbury Automotive, ABG, $4 billion. Versus LAD and PAG, AutoNation is the most geographically diversified. Versus KMX, AutoNation offers franchise dealer relationships and manufacturer captive financing that KMX's used-only model cannot replicate.
Options activity was neutral. Put-call ratio of 0.88 reflects slightly bullish positioning, but without strong conviction. Macro uncertainty on the rate environment, particularly around Federal Reserve timing on rate cuts, is keeping positioning muted. The options market implies annual volatility of 25 to 30%, consistent with a cyclically sensitive retail stock.
CEO Mike Ferrando purchased 3,000 shares in March at approximately $93, a constructive insider signal. CEO buying during a period of unit volume pressure signals management confidence that the used GPU stabilization thesis is intact and that AutoNation finance growth provides an earnings floor. Institutional holders include Vanguard, BlackRock, and Eddie Lampert affiliated entities.
Bottom line on AutoNation, a resilient automotive retail model beating earnings despite top-line headwinds. The 10% EPS beat on service revenue strength and used GPU stabilization is the key signal. At 14 times forward earnings with CEO buying, the downside is well protected at current prices. Rate cut timing is the upside catalyst. Any meaningful rate reduction would unleash pent-up new vehicle demand and drive immediate GPU recovery.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street